Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, well, long-term investors in and observers of Apple know that a big part of this story is product refreshes, new products, the newest versions of the iPads and the iPhones and the watches and all that kind of stuff is important for this company. And Apple had an event today where they unveiled some new iPads. So the question is it time to upgrade your iPad? Mandeep Singh joins us here. He covers all the technology stuff for Bloomberg Intelligence. Mandeep, looking at Apple shares up about 0.5%. Talk to us about the new upgraded iPad. What is it, and how important is it to the company these days?
Yeah, I mean, look, iPad line is about a high single-digit contributor to their overall revenue, so not as big as the iPhone, of course. But clearly, they are trying to put their latest chip in the iPad. They showcase a new keyboard for the iPad, and there were other battery enhancements, new OLED display. So all these are cool, but fundamentally, you have to ask yourself, is it worth to upgrade to a new iPad with all these incremental features, as I would like to call? And that's where I think the market is anticipating more along the lines of what can you show me in terms of AI and the wow factor around LLMs. And I think that's what was missing at the event.
Well, what could they show? I mean, when we talk about AI and Apple, what are we thinking about? Because Mark Gurman says that this is an AI-focused Pro model. So I'm wondering, apart from the chip, what about it is AI?
It's at the app level. So that's why that operating system upgrade, and they did talk about the iOS 18. Look, right now, the current version of my iPad, which is 5 generations behind what they launched, can run the latest version of the iOS operating system. So why do I need to upgrade? They have to give me a reason to upgrade to the latest iPad because my current version can't run the operating system, and it's got some cool apps. That is what was missing. Like, what functionality can you show me around Siri, around image editing, around summaries? Like all the cool stuff that we talk about from NVIDIA at the data center level. That's what a small kind of version of it is what you want to run on device instead of going to the cloud. And that's what they got to showcase in terms of why you need to upgrade to the latest hardware.
Okay, so Paul, this is not our first rodeo. No. You and I have anchored before. And one thing that's different than versus a few years ago, when I would walk in here, you would have an iPad next to you.
Yep.
And the iPad, you told me, was like a really big part of how you prepared for the show. You used the Bloomberg terminal on the iPad. You also have the 2 screens for the terminal. You have no iPad anymore.
Nope.
Why not?
I still have the iPad, although it's probably the original version, but now everything's on the phone. I mean,
So your phone has replaced your iPad?
Absolutely. And I have a very long train ride every day, which I need a very engaging device.
And your phone is that. It's not the iPad. So Mandeep, how big of a problem is that for Apple?
I mean, look, in their case, some of their newer products do cannibalize. If the iPad is very good, it's going to cannibalize the Mac sales. And if the iPhone is very good, it's going to cannibalize the iPad sales. So that's always been the case, but it's still a very sticky operating system and, just ecosystem overall. The only problem that I think people are trying to grapple with here is what is the refresh cycle? Because right now, the refresh cycle continues to get longer and longer. It's not as if, people are moving out of the ecosystem, but they're not gaining more Android users because they don't have the best looking phones or the best features that Android phones can offer. And so that is the part that is hurting their refresh rate and also the share gain from Android users.
June meeting, their developer meeting. Anything on the wow factor? I mean, is there a chance in their June developer meeting that they're going to come out with something that's going to blow the street away, or expectations low?
I mean, I'm expecting more emphasis on the software side in that developer meeting, and clearly they need to showcase what they are doing around the LLM strategy, whether an LLM, large language model, will be part of their OS, and then how it influences the overall app ecosystem. Because those are the features. If you look at the latest Pixel phone, they offer you a lot of those features already on Android. And that's what the Android ecosystem is looking to leverage more and more of. Look at the latest Samsung phones. They are targeting a lot of those Gen AI features, and Apple is really playing catch up over there, and they need to showcase that at the WWDC when they have all the developers over there.
Mandeep, this is something you think about a lot. So lay out the ultimate vision for us. What does Apple want its devices to be able to do for us from an AI perspective? Like how is it going to interact with me using AI?
I mean, the biggest kind of UI upgrade they can offer is around the Siri. You know, the fact that Siri is so underutilized right now as a voice assistant, if it has the right set of Gen AI features, clearly that will have a big influence on how we interact with the next version of the phones they make. And also, you know, some of the utility inside the app, like you don't have to, kind of touch everything or do everything manually in terms of giving instructions. There is this concept of AI agents that has to be front and center in the next version of software that Apple offers within their operating system, so that AI agent can automate a lot of the tasks, not fully, but pieces of it. And you want to see Apple making progress on that front.
All right, Mandeep, thanks so much for joining us. Appreciate it. As always, Mandeep Singh, he's a senior technology analyst for Bloomberg Intelligence, giving us the latest. Again, Apple had their new product unveiling of the new Apple iPad. And I think what I've heard from Mandeep, and Anurag Rana also covers technology for Bloomberg Intelligence, is in terms of new product launches and refreshes, it's really just evolutionary. They just iterate on the margins as opposed to something really radically new that'll cause everybody to run out and buy a new product. Those days are probably behind Apple.
People have said that in the past, though, Paul. Mm-hmm. So I see where you're coming from, but there would be those people who said, you know what, they said that when Steve Jobs died, and look what's happened over the last 10 years. I will say, I think they need to move the AirPods from a hardware category to services, because I am just... It's like I need a subscription to these things because I lose them so much.
Yeah, exactly.
That's the issue.
Yeah, exactly. So, but it's interesting. So that's why, if you do think that it's less of a product story, then you focus more on the services side of the business, which is about 20% of their revenue, and it's growing double digits, and it's a higher margin business, and that's a good story.
Gurman has talked to us about AirPods actually getting some AI features too.
Really? Okay.
And lenses, maybe. We'll see.
All right, we'll see how it goes. To me, if I'm an investor in Apple, it's just all about China. I'm concerned that the demand there for my products and services is going to be less going forward, and that's a concern. That's one of the concerns for the stock. We'll certainly keep on top of that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I've been covering Walt Disney for 35 years. There was a time when I got paid for my research on Walt Disney. So, of course, I looked at the results this morning. Said, the stock will trade up, down 8%. So what do I know? So let's go to somebody who's much smarter than any of us here about this kind of stuff. That's Geetha Ranganathan. She is the media analyst for Bloomberg Intelligence. Geetha, what does the street not like? I thought it was a pretty good print there for the company.
It certainly was, Paul, but what the street didn't like was the outlook. The outlook for the fiscal third quarter, especially for the theme park business, was definitely weak and not something that the street was expecting. So consensus had a 12% growth in operating income for the parks business. What Disney said, 0 growth.
Wow.
And that kind of really spooked investors. And they talked about different aspects here. They said that they have, 3 new cruise ships that are basically coming on board. And, there are launch costs associated with that. They're also opening this new kind of private island along with their vacation club and cruise business. Of course, that also, is contributing to that. But I think what really has investors super nervous at this point is that they spoke about a moderation in demand. And this has been a constant question for Disney. Can that park's momentum sustain, and how long can it sustain, and will they have pricing power? And I think this is where you're kind of seeing, the negative reaction come in, because people are not so confident anymore.
Is the moderation of demand about Disney's lack of exciting things to draw in people to the parks, to draw people to the theaters, or is it about a story that has to do with the consumer and the way that the consumer feels strapped?
I think it's a little bit of everything, Tim. So, definitely the consumer, the overall health of the economy and the consumer for certain, and, tremendous inflationary pressures. But of course, for Disney, one thing that they've done over the past few years is they've really raised prices in their parks pretty dramatically. And it's becoming increasingly expensive for, a family vacation. So, to the point of almost becoming prohibitive. And, that's where kind of that whole pricing power question comes in. I think they're going to have to do it much more cautiously and gently in the future.
Paul, talking to some neighbors the other day who recently took their kids to Disney.
Yep.
They were adding up how much it cost for just a couple days down there. They were saying probably about $5,000 is what they spent in Florida.
Wow.
2 kids, a few days down there.
Wow.
It's a lot of money.
And you need an advisor to set all this stuff up because it's so complicated.
Yeah, so I've heard with these
I just call Geetha. She makes a phone call, and I'm like the front of the line every time. Geetha, the other part of this story, and for the longest time, for the last 4 or 5 years, has been their streaming business. And when will that business turn profitable? They had some pretty good news on that front, didn't they?
They did, Paul. I mean, we're just on the cusp of a major earnings inflection point here. For the first time ever in the streaming business's history, they actually posted a modest profit. Now, again, they said fiscal third quarter, which is the next quarter, is going to be a little bit choppy. But then what they've said all along is that expect some really good results in the fiscal fourth quarter, and then they're really going to build on that starting in fiscal 2025 and beyond. They have a lot of initiatives in the works. They're cracking down on password sharing a la Netflix. And remember, that has been a huge growth story at Netflix. Netflix added almost 35 million subscribers after they started cracking down on password sharing. So Disney can also hope to see quite a lot of success with that. And then, of course, they also have the Hulu integration as well as, the ad tier, all of that kind of contributing. So streaming, I think, is going to be a considerable source of earnings upside in the next few years.
How's Bob Iger doing?
He's having a successor.
He spoke about that actually on the call that came up, and he said that they're kind of actively considering. They have 4 internal candidates, all of the division chiefs that are kind of up for consideration, and he said that they're looking at them very carefully, and the announcement will come when the time is right.
Is this any replay of what happened a few years ago when Bob Chapek took over? I mean, it kind of sounds familiar. A number of internal candidates, the person gets picked, the other ones leave, and then Bob Iger comes back because it didn't work out.
Yeah, I mean, we've seen this movie play out so many times now at Disney. I hope, and I think this time it really will be different. I mean, that was the whole bone of contention, for the activist investors, including Nelson Peltz. And I think having this new succession planning committee suggests that this time they will do things probably a little bit differently.
All right, Geetha. So clearly, looking at the stock down 8%, the market clearly is focusing on that theme park business, and for good reason. It's become, kind of under the radar. It's now become 70% of their operating income. So it is the business here. What did the company say about their ability to potentially deal with maybe weaker demand? It's been a long time since we've seen them ever cut prices at the theme parks, promote, at the theme parks, anything that would hurt profitability. It's been a long time since they've had to do that.
Yeah, I mean, the theme park business has been such a consistent story for them, Paul. As you just pointed out, they have 25% operating margin in that business. And they are really looking at this as a future earnings growth driver, which is why, they're investing $60 billion in the theme parks over the next 10 years. Over half of that is basically just adding capacity, adding new attractions, and I think it's a really timely and a good strategic move. They're also bringing on those cruise ships that's going to cost them about $12 to $15 billion. So they're definitely adding capacity. So I think overall, definitely the business is in good shape, but in the near term, obviously the sentiment has definitely soured.
Well, speaking of souring sentiment, curious about the media business here. Apart from streaming, the legacy media business, talking ESPN, talking ABC. What did we learn about that business?
Bad.
Okay.
So legacy TV networks, the operating income was down 22%.
Wow.
That's not surprising, but it's just the rate of decline. I mean, we were expecting, maybe high single digits. This is really bad. And what gets worse is, we're obviously hearing about all of the sports rights negotiations that are ongoing. If you look at the NBA deal, for instance, that's basically looking at tripling the sports value. So their previous deal was about 25 billion. New deal will be over $75 billion. And so these companies are going to have to pay up just to kind of maintain the status quo, or maybe not even maintain the status quo in their TV networks business, which is really going to crimp profitability pretty significantly.
So, I mean, it begs a question. Your costs are tripling. Your revenue's not tripling. Is streaming going to pay for all these sports rights? How does a company even position that in the marketplace?
That's what they're betting on, Paul. I'm not sure that streaming is going to be able to reclaim all of that leakage that we're seeing on the linear TV side, but they're definitely betting that it will be able to salvage some of those losses. So, ESPN, for instance, they are having obviously their new standalone app that is going to come out sometime in 2025. And then they have this new sports JV that again is supposed to come out a little bit later this year, along with Warner Brothers Discovery and Fox. So they're doing different things. Again, not sure whether how successful it's going to be. That's still a little bit of a wait and watch.
Geetha, we're so lucky we have you because you not just cover Disney, but you also cover Peloton. And shares of Peloton higher by 12% right now. This after CNBC reported that a number of PE firms have been considering a buyout of the company. They cited people familiar with the matter. What could a private equity firm do with Peloton? Like, how could a PE firm make Peloton successful, solve its problems?
Cut costs. I mean, that's what PE firms do best. And Peloton really has had a huge cost problem. And the cost problem is because the costs haven't really been aligned to its revenue base. Its revenue has been steadily decreasing, just a combination of different factors: weak demand, a saturated market. Their new products haven't really taken off. They've tried all kinds of different things with a whole new digital app revamp. Again, that's really not done the way that they wanted it to kind of perform. They have all these other partnerships with Lulu. They had this new hotel partnership. Again, nothing has really been a game changer, but the costs are still very, very high. And that's just because it's cost them so much to manufacture their equipment. And so PE can kind of really come in and trim that cost base.
All right. Geetha, thanks so much for joining us. Geetha Ranganathan, she is the media analyst at Bloomberg Intelligence, folks. She is, over the last 15 years, has built up an amazing franchise on Wall Street as being one of the leading research voices on that space, and it's been undergoing a tremendous amount of generational change in the media business, from the traditional cable TV satellite delivery mechanism to this whole thing called streaming. It's required a lot of work, and a lot of folks on Wall Street pay attention to Geetha's research. You can find Geetha's research and all of the Bloomberg Intelligence research on the Bloomberg terminal. BIGO is the function that'll get you there. It's good stuff. Disney stock down around 7-8% here. Again, concerns about maybe peak theme park demand there coming out of the pandemic, maybe getting back to a more normalized level of attendance. But what we've seen over the years from Disney is they really know better than anybody else how to price their theme park product and how to invest in and how to generate returns. So longer term, I think a lot of people feel pretty good about that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Our next guest, Sandi Bragar, joins us. She's the Chief Client Officer at Aspiriant, joining us live here in our Bloomberg Interactive Brokers studio. Sandi, it's funny, this market here, a lot of folks, we had that nice run off those October lows. People felt like maybe the market got ahead of itself, and then we had the Fed saying, gee, maybe we're not going to cut rates, maybe we're going to hike rates, and people got a little spooked there for a while, but it seems like we're back on a positive trajectory here. How do you guys think about the markets and maybe get away from that day-to-day type view of the markets?
Yeah, it's hard to get away from the day-to-day, especially when it's bouncing around so much, and depending upon the day, you have a different view of what's happening. But our clients are corporate executives, family business owners, entrepreneurs, inheritors. They're really thinking about their portfolios for the long term, and they're not so worried about what's happening on the day-to-day, so that takes a little bit of pressure off of us, although we get questions about the day-to-day all the time. our best advice to our clients is really to be prepared for anything in this market. So we're playing both offense and defense simultaneously in portfolios. Just being prepared for a range of outcomes.
What are the types of questions that you're getting? Like when your phone is ringing, when your email inbox is pinging on days when we're seeing volatility, what's the question that your clients are asking?
It's either, should we raise more cash or should we put more cash in?
I mean,
and it might be the same question from different people on the same day.
And let's be honest, like when the question is, should we raise more cash? Your job is to say no.
We think it's really important to be invested, and because we're putting together an investment portfolio based on our clients' financial plans, we have a good sense of how much cash they need at any given moment. So everything else that they don't really need for the near term, we are recommending that they invest. And we talk about why we're investing the way that we are and really help hold clients' hands through that moment. Now, for the clients that are willing and wanting to put more money in, that's actually a good sign, because for a while people were so excited about yields on money market funds.
Yeah.
You know, we hadn't seen any return on cash in so long that people were feeling really comfortable bulking up on cash. And so now they're ready to get invested. And those conversations go well too. Interestingly, we've started having clients take steps into bonds on the longer term side. We think that in this environment where rates are high, it's nice to lock in some of the current rates. And if we do see some softening in the economy, that should do well for bonds, high quality, intermediate, long-term bonds. And then on the equity side, we're really focused on where are the opportunities. And we think because of the narrow range of the market over the last 6 months, that there's plenty of interesting stocks out there that haven't rallied. And it does look in recent days like maybe that's opening up. So we're excited about that.
When you say playing offense, what does that mean to you guys?
So looking for opportunities to invest where there's a high likelihood of achieving a good return on that investment. So for us today, that would be in value stocks here in the US and overseas. I would say about 55% of our overall equity allocation is overseas right now, with a fair amount in emerging markets. Yeah, because I mean the US has just been so strong. Things are happening differently outside of the country.
Is your argument that there's like a reversion to the mean here? Or because if you look at the past decade, I mean, the U.S. has outperformed everywhere else.
Yeah, valuations are so high, and
it's been ugly if you've been overweight international.
It has, but we think there are great opportunities, especially as things get pricey here in the U.S. When we look at valuations, we really do see some great opportunities overseas.
Okay, then conversely, if I'm playing defense, what does that mean to you guys?
So defense today is a fair amount of bonds. You know, for the last several years, we weren't putting very much emphasis in bonds and portfolios as rates were increasing. We think, you know, we have no idea what the Fed will do, but we think we're much closer to a Fed rate shift than we are to more increases. And so we think fixed income is a good place to be. We think it's going to play its traditional role in a portfolio, helping buffer to volatility and provide some solid returns. And right now returns are about 2% after inflation, so not so bad.
Okay, so somebody comes to you with a pile of cash right now. They say, I need you to put this to work. Where do you put it to work? I know it depends on their time horizon, how old they are.
Yeah, so we're going to do a full comprehensive plan, but assuming that there are folks with a long investment time horizon, we're probably putting about 55% of the portfolio in equities, as I said, with about half of that, a little more than half overseas. The rest of the portfolio we're managing defensively, so maybe 35% in bonds and 15% in liquid alternatives, because we do think that they're nice buffers for volatility as well and provide a different...
Did you say illiquid alternatives?
So liquid alternatives.
Liquid alternatives,
yeah,
okay.
Liquid alternatives.
So what is it? Like, I guess I was surprised. We were doing a remote broadcast at one of our RIA sponsors, and I was surprised that the average RIA out there, they're saying that registered investment advisor, they're saying that their clients really have an interest in alternative investments, like more than the 5% or 10% token that I would suggest, like much higher. What are you seeing in terms of demand for alternative investments, whether it's hedge funds or private equity or any of that kind of stuff? And then where do you steer your clients?
Yeah, so in terms of the more hedging, that's what we're doing in the liquid alternatives portfolio. So clients are feeling good about that. But we have seen in recent years a bigger interest in private equity than ever before. And we think there is definitely a great place for private equity in portfolios. But we're really looking at portfolios that are $20 million and up, where people can really have a long investment time horizon and take some risk with their portfolios, because even though people have been really excited about PE, there's very few winners in that crowd.
But I wouldn't consider private equity liquid by any means.
No. So that would be in a liquid portion for sure, which is also why we're looking at clients with the much bigger portfolios for that.
Who is a typical client for you guys?
So corporate executives, family business owners, inheritors.
See, I didn't get inheritor.
I was going to say, I don't remember that being a choice when I was majoring in school. Like,
inheritor.
Nobody ever said, hey, inheritor. It could be something you choose career-wise.
Do you guys buy off on this whole thing? Like, I guess I read a lot about the baby boomers have so much wealth, and how do they get it to the next generation?
The great wealth transfer.
Yes.
Yep.
Exactly.
That is in motion, and we spend
I tell my kids, the last check I write is going to bounce, baby. That's how you do it.
That is a strategy.
Yep.
That is a strategy.
I like that.
But it is a conversation we're in with many of our clients, and it actually presents some really interesting investment opportunities, because when they are transferring assets out of their estate for the rising generations of their family, that's money that has a very long investment time horizon, and so they can get quite risk-loving if that's the direction that they want to go in.
Okay, typical portfolio size.
For
you guys.
25 million.
Okay.
Yeah, I think that's our.
And is it
25 to 50 million?
60-40 plus we allocate some alternatives? How do you start? I know it probably depends on the individual, but do you start like 60-40 and then decide how much you want to take away from that, put to alternatives?
So we do take a valuation-driven approach. So our allocations are based on where we're seeing valuations in the market. So we don't have a fixed asset allocation. We have dynamic ones where clients give us the discretion to move within bands. So today, as I was mentioning, we're more like 55, 45 sort of allocations on average, but there's a very big range. And then for a client, when we're looking at their investment portfolio, there's a lot of conversation that we're having with them, not only about their goals and what's most important to them and their long-term plan, but how are they feeling about investment markets? How have they reacted in the past when markets have gone south? Really trying to help hone them in on what's the right place on the risk-return spectrum for them.
Are you running into any challenges from clients coming and saying, look, I've seen how the S&P 500 has performed over the last 10, 12 years. Had I just put my money in VOO, it would have outperformed my portfolio?
There are some clients that feel that way. And a lot of conversation about, again, where are you relative to your plan? And was the objective to get the highest return? Because in retrospect, it's really easy to see how we could have gotten there. But we've been living through very interesting time periods, and what we've seen in the recent past, we don't expect to continue going forward. So lots of conversations with clients to help meet them where they are and get them through these markets.
Sandi, thank you so much for joining us. Sandi Bragar, she is the Chief Client Officer for Aspiriant, based in San Francisco, California, but joining us live here in our Bloomberg Interactive Broker Studio. Appreciate her making the trip all the way across the country just to see us. Go figure.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
John Mandyck joins us here because we're going to shift gears. He's the Chief Executive Officer of Urban Green Council. He joins us here in our Bloomberg Interactive Broker Studio. Welcome for coming in. You get extra points for not mailing it in. Electrification of buildings. How do we power our buildings today?
Well, in New York City, the largest source of carbon comes from furnaces, boilers, and hot water heaters. It's natural gas in the basement for heat and hot water.
Okay.
So that's our largest source of carbon. That's our biggest
I thought natural gas was clean burning energy.
Well, it was compared to coal.
Okay, but that's still not good enough.
But it's not good enough.
Okay, so I recently moved from a hybrid electric-powered and gas-powered home, where gas did our hot water and our stove and oven, into an all-electric place. And here's what happened. The oven doesn't work very well. The stove works incredibly well because it's induction. The hot water heaters, it's kind of okay. Our electric bill is huge, but we got no gas bill. Our electric bill is so much now. It's more than it was before with gas added.
Right. Well, there are artificial incentives built in the system for natural gas, and those are starting to be addressed. For example, in New York State, if you're within 100 feet of a gas line, you can demand to have service, and everybody pays for that.
Wow.
And so we have to get to where electricity has the true price and gas has the true price, and so those two can compete. And over time, with conflicts around the world and where we see climate policies going, there's going to be a carbon price built into natural gas.
Okay.
Well, how do we most efficiently electrify a building?
Right. Well, we do it by installing heat pumps for heat and hot water, and that's the main way to do it. In New York, like I said, our problem isn't lighting. Our problem is the heating and hot water. Then, of course, you need the grid to green at the same time, and that's happening as well.
Is an electric-powered hot water heater more or less efficient than a gas-powered hot water heater? Same with like a dryer, for example, because you can get a dryer that's has a gas-heated element, but in these newer buildings where they don't allow gas, you're stuck with electric. Is it as efficient?
Right, and they're getting efficient for sure, and they're getting to parity.
The heat pump works really well.
The heat pump is very efficient. It can be way more efficient than the natural gas boiler or furnace that you already have.
What about when it comes to the other appliances, though?
They're getting there, and
but not yet.
Hot water. No, there are hot water systems that are there.
Okay.
And we need more technology to come on board when it comes to hot water, particularly to scale across all the different type of building types in cities. But we have the largest decarbonization market in the world now in New York City, and that's going to spur innovation to help serve this market.
The thing that's a challenge to me when thinking about this, and look, no question, I want to do what's right for the environment, what's right for the world. Where is this power being generated? Because it's not being generated at Indian Point anymore. That's shut down, so it's not nuclear. Here in New York City, we're still relying on a lot of dirty sources to power. So whether or not we're heating with gas or electricity, net doesn't really matter if that electricity is generated by a dirty source.
It does, because today's heat pumps are so more energy efficient that you're just using less energy, which means you're using less carbon, and it almost doesn't matter what the grid is, right? But at that same time, the grid is greening in New York, right? We did lose Indian Point. That was about a third of our power in New York City. That was fossil fuel free. That's being replaced by hydropower and renewable power that's coming in as soon as 2026. So the grid is greening, and that's going to help when we start to plug more things into that grid.
Is the grid, because I read the book, The Grid. There is a book out there, and I have John Tucker reading it now, and it talks about the history of electricity in this country, which is fascinating. I look like a geek sitting on the Jersey Shore 2 summers ago.
I feel like I got to read that. I got to read this book.
It's no way to pick up girls, I think, reading the book about the grid. Can our grid today handle increased electrical demand?
It can for heating, right? Okay. So our organization modeled all 1 million buildings in New York City against the local Con Edison grid. What we found is there's a 42% headroom in the winter to plug things into the grid. So said a different way, our grid is built out for the hottest day of the year, right? And when we turn those air conditioners off, 42% of our grid goes dormant. It's actually a very inefficient use of assets. So there's 42% room to plug stuff into the grid because our heating source is not electrical based today, it's fossil fuel based.
So what would you say is the biggest thing holding us back when it comes to wide scale adoption of more electricity and less gas? Is it because these legacy systems are going to take so long to replace?
It's that. We have laws now in New York State and New York City, and actually about 100 jurisdictions around the country that are forcing the transition.
So what that does is it tells developers, okay, if you're going to build this, you can't include a gas line here. It has to be all electric, right?
Correct. So in New York City, starting this year, buildings under 7 floors, new buildings, have to be all electric. And then in 27, all new construction needs to be all electric in New York City.
I've talked to developers who say, okay, the regulations are not there yet, but it is such a pain for us to deal with gas these days that we're just going all electric.
So what are the incentives today for, like, I'm just thinking of Jamie Dimon building that new building on Park Avenue. I mean, talk about going to be state of the art when it's finished. I'm guessing he's going to hang all the plaques how it's this compliant and that compliant, and we won this award and we're triple green this. What's a new building like that today? What are they trying to do for their energy?
Well, sure, but there's the heart of your question on incentives. There are way more incentives now than there's ever been in the history of this issue, right? Primarily from the federal government through the Inflation Reduction Act, but also by states around the country that are, putting their money where their mouth is when it comes to public policies.
Are you optimistic about the greenification of the grid? Like, is this something, we talk about offshore wind, for example. Look at all the the politics around that and look at all the issues it faces. We just talked last week to Will Wade, one of our reporters here, who wrote about nuclear power plants around the country that are coming back online potentially because they turned those things off and they were like, oh, wait a second, this was actually a green source of power. Indian Point, not one of them because they're dismantling it. Is the timeline here realistic?
I think it is. Look at, offshore wind went live at the end of last year off of Long Island for a part of Long Island. There's 2 big mega projects for offshore wind. We're getting Canadian hydropower in. There's upstate New York excess renewable power. We actually have a bottleneck, and we're building transmission lines to get that into New York City. So I'm confident that the grid is going to green. The impetus is there.
Is that a state or is it a federal mandate? Because I could see this breaking on political lines, red states maybe being more open to green, so on and so forth.
Yeah, sure, it does fall along political lines, but the renewable energy that's happening in New York is state-driven. The offshore wind is controlled by the federal government, but those were sited years and years ago, and so those projects are moving forward.
What about solar and solar efficiency? I talked to some neighbors who are like, okay, we want to do solar, but the payoff is, it's a very expensive capital expense. Financing is really high now because of rates. And they're like, it pays off in like 12 years. That's a long time.
Yeah, it is, but we need all of the above, right? And so the issue in big cities is we just don't have a lot of place to put solar panels, right? And so offshore wind is going to be the future of renewable power, and that's where you see the projects going.
We looked into covering it at our old apartment building, which was like 5 floors, 90 units, and the assessment we got, Paul, was like, it'll cover 5% of your monthly usage.
Really?
If you did the whole roof.
Yeah.
Yeah. Just because it's a big building and not a lot of roof space.
Yep. Well, our Princeton campus in New Jersey, huge wind, solar farm down there. Yeah,
just depends on the location.
Yeah, so they're all in. So I'm not sure how much sun they get in New Jersey, but we'll see. All right, John Mandyck, thanks so much for joining us. John Mandyck, he's the Chief Executive Officer at the Urban Green Council, joining us here in our Bloomberg Interactive Brokers studio, talking about, electric vehicles get a lot of the headlines about energy transition, but there's a similar trend going for buildings around the country. And so we'll see how that technology develops.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Tesla, more news out today that I think is buffeting the stock here. First and foremost, Tesla Autopilot probe escalates with U.S. regulators' data demand. So that's an issue for the company. And then also reported today that Tesla going to have some April decline in China shipments. So again, goes to that demand issue. Let's bring it all to bear here. Craig Trudell, Global Autos Editor for Bloomberg News. He joins us from London via Zoom. Craig, again, a lot of issues, a lot of cross currents for Tesla. Let's start with issue number 1 today, which is just this autopilot probe here. Give us the background here and give us kind of the lay of the land on this particular issue.
Yeah, this goes back quite a ways. We saw federal scrutiny of autopilot almost from the beginning when there was a fatal crash way back in 2016, around the time that Tesla started to market this technology. It sort of gives people the impression from the name, at least among some people, that you can maybe tune out, or that the driver will, the car will run on autopilot. In this case, and in the case of full self-driving, however, you, the driver, are in control and are responsible for the vehicle. And one of the big problems that Tesla has had has been keeping drivers in control and attentive. And so, in August of 2021, the National Highway Traffic Safety Administration opened a probe into whether autopilot was defective. While it closed that probe recently, it opened a new one having to do with a recall in December. So Tesla tried an over-the-air software update to guard against misuse of the system, and there have been 20 crashes just in the handful of months since that over-the-air software update. So NHTSA is looking into whether or not that recall was effective and whether more needs to be done here.
Is there any feeling from Tesla or any statement from Tesla about how they plan to either fix this or maybe update the autopilot and improve the autopilot technology?
I think we will keep a close eye on Elon Musk's X feed. That seems to be the sort of only means in which this company communicates to some degree. But I do think one of the interesting things here is we have seen him in the past sort of rail against outdated language around recalls. And in the case of Autopilot, I mentioned the over-the-air nature of this fix that they deployed in December. I think one of the keys for investors is a concern as to whether or not that's going to be sufficient. Do they need to install a different type of camera, or in some vehicles even just a camera at all, to pay attention to whether the driver is paying attention and monitoring the driver and doing more to sort of measure and evaluate engagement. And they're really being asked to cough up quite a bit of data here, and are being given a deadline of July 1st to hand over that information to give NHTSA what it needs to determine whether this recall did enough.
Yeah, and this feels really important for Tesla, because I think Tesla, in terms of the investment narrative, they're trying to get away from focusing on the number of vehicles sold to thinking more about Tesla as a AI company, as a robo-taxi company, as just the technology that can maybe be used across the industry. So they need to get this stuff right, don't they?
They do, and I mean, to Tesla's credit, I mean, the over-the-air capability that they built into their vehicles was really novel when they were first, sort of coming onto the scene. I'll never forget that, the Model 3 was coming out, and the brake distance was not up to snuff for Consumer Reports, which was evaluating this, new car that was really important to Tesla at the time. And speaking of Musk's, I guess then Twitter feed. He sort of said, I'm on it. They did an over-the-air software update. Consumer Reports retested the car, and through an over-the-air update, they were able to shorten the braking distance. And the question here is whether Autopilot, if they do need to come up with a hardware solution to fix a defect with Autopilot, that's going to be expensive, or has the potential to be very expensive, especially since this is a company that doesn't have a franchise dealer network. They would have to, deploy service vans to cars and go fix this stuff, which is going to cost a heck of a lot more money than flashing a software update over the air.
All right, issue number 2, at least for today as it relates to the stock, preliminary data from the China's Passenger Car Association showed shipments from Tesla's Shanghai factory dropped 18% year on year in April, even as the broader market for new energy cars grew. Not good news for Tesla. What do we know?
No, and it's been the case that this is a company that tends to have a lot of up and down months in terms of how they build their cars. They've tried to move away from this, and I don't think we've necessarily seen a whole lot of follow through there, where you tend to see lulls in the beginning of each quarter, followed by a sort of end of quarter push. And so March, December, these end of quarter months, you tend to see an uptick, but then a sort of drop off in the subsequent months. I think in this case, though, the year over year change is in and of itself plenty alarming, especially when you compare Tesla against some of its Chinese competitors. A lot of these companies really are not having the demand problems that we're seeing Tesla have. And I think it's also problematic in the sense that wholesales from this plant in Shanghai are also a reflection of demand here in Europe, because this is a plant that has been a export hub for Tesla, and so it's not only an indication of some softness in China, but potentially in export markets, including Europe.
Interesting. So that kind of goes to that. I think probably the overarching concern for Tesla and just for the EV business in general is just the ultimate end demand for EVs here. So we'll have to see how that plays out. Craig Trudell, thank you so much for joining us. Craig Trudell, Global Autos Editor for Bloomberg News from our beautiful New York headquarters in London, Queen Victoria Street, coming at us via Zoom. Again, Tesla stock off 2.8% today, off 28% year to date. on a trailing 12-month basis, eking out about a 5.5% gain here. So there's definitely some concerns there for Tesla across the board. I think they're pretty well known. But again, for me, it kind of all comes down to where is demand for EVs in general, not just for Tesla. I think that's a big concern for a lot of investors and a lot of for the traditional automakers as well. Market cap, $570 billion for Tesla.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.